Hi, Mike Matousek here, head trader at US Global Investors. Today, we're talking about seasonality. I'm sure you've heard the phrase, sell in May and go away. What does it mean and does it work? The idea behind the strategy of selling in May and repurchasing the US equity investments in October stems from the belief that the summer months are the worst performing months in the stock market. Investors believe they can avoid these negative months by selling equities in May and then buying back just before the seasonal fall rallies in October. This keeps investors out of the market during the majority of the worst performing months, namely June, August, and September, and keeps them invested during the rest of the year. To test this theory, I ran a backtest. As seen in the chart, the strategy of selling, then buying back would have returned you 419% since December 1996. I chose that year because it's the year I started out in the investment management business. Conversely, a buy and hold strategy would have only returned 254%. In this 6-month chart, notice the lower high prices were established in February, March, and April. Now it's been 3 months since the S&P corrected, and this shows the stocks are still struggling to regain their momentum. Now, due to the price declines, we're seeing declining average prices. This is a negative sign and shows there are sellers lightening up on investment exposure during price spikes. This behavior causes potential rallies to become muted, prices to become more volatile, and perpetuates a negative market bias, which seems to rhyme with the sell in May strategy. This is a great combination for the short-term trader seeking to fade advances. With all that pessimism, we need to look at the optimistic side that bodes well for the long-term investor. The next chart encompasses 1 year of data plus a 200-period average trend line. Notice how prices declined in late March, early April, and then again in early May. This decline seemed to slow and then reverse higher when the price neared the trend line. This is the type of price action indicating a continuing, mature bull market. Portfolio managers with long-term investment time horizons will most likely forego the potential upcoming volatility and use short-term headwinds to add to positions in anticipation of future higher prices. And there you have it, our technical and quantitative assessment. Trade smart and have a good day.